On the basis of our understanding of monetary policy tools, here let's continue talking about how money supply is controlled. Money supply means the amount of money or dollars held by the public, and mathematically it equals the currency plus the demand deposit. Okay. Now, let's take a look at the role banks play in money supply. Okay. Now, we're going to check out 3 different scenarios. The first one is there's no banks at all in the economy. Okay. And suppose Connor has $1,000 in his pocket, then the money supply is just going to be $1,000. Right? So here the currency would be equal to $1,000 and deposit is 0 because there's no banks at all. All right. So here money supply just equal to currency, the amount of currency. The second scenario, we're talking about 100% reserve banking. Now, I'm going to explain what does that mean in a second, okay? First of all, reserves means the deposits that banks have not lent out, okay? For example, if Bank of America receives $100 deposit and it lends out $80, so the reserves means in this case would be just $20. Okay, so that's amount of money the banks keep in their offices. Okay, the reserve deposit ratio (RR) is another term we're going to use in this discussion. So RR, for example, in the previous case would be equal to 0.2, right? So reserves is $20 and deposit is $100. So it's 20 divided by 100. So the ratio would be 0.2 or 20%. Okay. If RR equals 50%, that means for every $2 deposit the bank receives, it would lend out just $1 and keep the other dollar in its office. Okay. Now here, let's continue talking about this case where Connor deposited $1,000 in his account at Bank of America. Okay? And then how the money supply changes because of that, if any. All right. So here the triangle is the Greek letter delta, which means change in money supply. All right. To be able to do that, we have to conduct the balance sheet analysis. Okay. If you already took accounting or finance, you probably know that this thing called the T account. That means we record the assets and liabilities of our organization, right? Now here, let's talk about this. Before Connor deposited $1,000 into his account, so the currency would be $1,000 and the deposit would be 0. So the money supply is $1,000. Okay. Now, suppose he deposits $1,000 into the bank account, and Bank of America holds 100% of the deposits in reserve. That's why it's called 100% reserve banking. Okay, so the BOA keeps every dollar in its office, right? Then the balance sheet would look like this. Okay, so on the left-hand side, it's assets, and that is the $1,000 reserves. Okay, so physically these $1,000 are kept in the BOA office. That's BOA's assets. But at the same time, BOA owes Connor $1,000, right? So that's liabilities for the bank. And here below the liability, we put the $1,000 deposit here, okay? Now, let's recalculate the money supply, okay, after the deposit. So the currency now becomes zero, okay? Remember, we're talking about the currency held by the public, not held by the bank, okay? And then the demand deposit would be $1,000, okay? And so money supply is the sum of these two. It stays unchanged. It's still $1,000, okay? So here we can draw an important conclusion that 100% reserve banking has no impact on the size of the money supply, okay? Would this work in reality? Of course, no. Because from the bank's perspective, money is its raw materials. Okay, it's just like other industries. They use raw materials to produce product and make money. In banking sector, money is their raw materials, or more specifically here, deposits is their raw materials. If they keep every dollar they received as a deposit in its office, there's no way that these banks would survive. Okay, they cannot generate profit, so they have to lend the money out. Okay, if not all of them, they would probably lend out as much as possible. All right. That's why we're going to talk about the third scenario, which is a little more complicated but more realistic. It's called fractional reserve banking. So here, let's see, Connor deposited $1,000 into his bank account. So the starting point stays the same. But the difference is BOA held 20% of its deposits in reserve, making loans with the rest. Okay, so here we find that the BOA balance sheet would look like this. On the left-hand side, it keeps the $200 in its office as reserves. We get this number $200 by using $1,000 times 20%, okay, in reserve. And of course, the remaining $800 would be available for the bank to make loans. Okay. On the right-hand side, it stays the same. BOA still owes Connor $1,000. Okay. Now, let's continue. Assume that this $800 loan is made to Emma. So Emma received the loan and holds $800 cash. Okay. Now let's take a look at the change in money supply, if any. After the deposit, the cash or currency held by the public would be the amount held by Emma, which is $800, right? Deposit, it's going to be $1,000. Okay, that's how much the bank owes Connor. All right. Now the money supply, remember, is the sum of currency and demand deposit, so it's going to be $1,800. This is kind of the magic, right? Because what we find is that a fractional reserve banking system creates money. Okay. Remember, the money supply used to be $1,000 before Connor made the deposit. Now, after the deposit, it increases to $1,800. Okay, and the reason is because the banks continue lend the money out to another person. Okay, at the same time, it still holds liabilities. Okay, of $1,000. Now, you probably already guessed that this thing would not stop here. It will continue. For example, let's say Emma deposit $800 at Regions, okay? And then the Regions held 20% of the deposit in reserve, making loans with the rest, okay? Now, the Regions balance sheet would look like this. So the asset side, they have the reserves $160, which is equal to $800 times 20%. Okay, and then the remaining $640 is available for them to make loans. And deposits on the liability side equals $800. Okay. Now, whoever receives that, let me switch back. Receives the $640 loan. We're gonna continue our discussion from there. So suppose Jason received the loan of $640, and he made the deposit at PNC Bank. Okay, and again, PNC holds 20% deposit in reserve. So, I'm sorry. Then the PNC's balance sheet will look like this. Okay, so the reserve will be $128. That equals $640 times 20%. And PNC is going to make $512 loan to the next person, whoever that is. And then the deposit is $640. Okay. Now here, of course, this story can go on and on and on. Okay. If we make a stop here and trying to calculate the change in money supply, okay, we put everything together. So the original deposit is $1,000. Okay, this is held by Connor, and then the deposit at BOA is $800. Okay, and the deposit, I believe this is held by Emma, right? And then the deposit at Regions is $640. Then the deposit at PNC Bank is $512. So if we add up all of these deposits, and we would be able to find that, you know, the total, if this goes on and on and on, okay? So it's 1,000 plus 800 plus 640 plus 512 plus 512 times 80%, right? And so eventually the total money supply would be 1 over reserve deposit ratio, RR, times $1,000, which is the original amount of money Connor has. Okay, so in our example, the RR equals 0.2 because we assumed that each bank holds 20% of the deposit in reserve. So RR equals 0.2, right? And then 1 divided by 0.2 times 1,000. So the total amount of money supply at this moment is $5,000. Once again, you can find that this is much higher than the initial money supply, okay? Several times higher. And here, the common confusion would be, you know, banks create money and even wealth, right? That's not true. Banks can create money, okay, by keep making loans to the next person, but they cannot create wealth. So the wealth stays the same. Okay. Now, another way to look at this is every time when a bank makes loans, it creates new money, right? But don't forget on the liability side, the deposit would go up as well. So the banks or the banking sector would owe more and more and more to the depositors. Okay. So the total amount of the wealth does not really change at all, right? So here we discuss the fractional reserve banking system, how it creates money.